Now welcome back my dear class 12 student. So this is a class of accountancy and we are going through actually the chapter accounting ratio. Under accounting ratio we have learned last day in your previous class liquidity ratio, and under liquidity ratio I have discussed with you what is the current ratio. Okay, today under liquid ratio there is another ratio is there, that is quick ratio. Now what is quick ratio? What is the formula of quick ratio? So in quick ratio the formula is quick asset divided, that is in numerator that is quick asset and denominator current liabilities, not quick liabilities. Many of you wrongly done that is quick liabilities. There is no quick liabilities concept in there. There is only current liabilities, and why there is no quick liability I have discussed in your previous classes. Current liabilities. Now this is the formula. Quick ratio sometimes we call acid test ratio also. Okay. Now in the exam that may come, what is acid test ratio, don't be confused. This is same as quick ratio or liquid ratio. You can call it also liquid ratio. So there is a three name: quick ratio, liquid ratio and acid test ratio, and these three are same. Okay. The formula is quick asset by current liabilities. Now what is quick asset? That's also I discussed which asset you can easily convertible to cash. Okay, which asset you can easily convertible to cash. According to current asset, we know in current asset this asset we can convert into cash within a year. That's why they are called current asset. On a 1 year operating cycle we can convert into cash. Now quick asset they are saying you can easily, maybe 1 month time, okay, maybe 15 days. They are the most liquid asset in your organization, holding by your organization. So that's why this is called quick asset. Now current liabilities, you know, more than one, within a 1 year you have to convert it, you have to pay these liabilities. These are not long-term liabilities. There are two types of liability. One is non-current liability, one is current liability. Okay. So non-current liability is a long-term liabilities and current liability is short-term. Means within 1 year you have to pay all the liabilities. So here we can take an example from your book, and through that we will learn how we can solve the problem of quick ratio. If there is a problem given, how can we reveal, how can we come out to result of the quick ratio? Now here in page number 209 in your NCERT book you can see this example I have also taken for make you understand what is current ratio. The same example I am taking in here, that is inventories. That is example number 1. There is inventories, there is a trade receivable, there is advance tax, there is cash and cash equivalent, there is a trade payables, there is a short-term borrowings, that back in bracket bank overdraft. Short-term borrowings means bank overdraft. And what is bank overdraft? That I also discussed when I was going through the chapter cash flow statement. So each and every item is very familiar for you. So now we can start. How we just look, how can we resolve, how can we come out to resolve, how can we reveal the quick ratio. Now here first whatever you have to do, now first we have to reveal what are the quick asset in your organization in this example. Now quick asset. Now quick asset, and you can see current asset minus inventories plus advance tax. If you from current asset, inventory is also a current asset, advance tax is a current asset. So how can we come in quick asset? From current asset, if you deduct the inventories and advance tax, then you come to the quick asset. Okay. Now, why we deduct the inventories and advance tax? Now, inventories, you know, inventories is not, what is inventories? What is inventories means stock. So, these goods is still lying in your organization because it yet not sell. Now, when it will be sold, that is very uncertain. In case of debtor, you have already sold the goods, but you know the particular person from where you actually received the money. So that's why this is a quick asset. But in case of inventory, the goods is yet not sold. So how can you know when the money will come to you? That's why this is deducted and this is not considered as a quick asset. And second is advance tax. Advance tax means the cash you already paid as a tax. Okay, you have already paid because you sometime what's happened, there is a advance tax. Actually, the tax you have to pay to the government advancely because you know there will be tax for your organization. That's why some tax. And in income tax rule, the advance tax rule is there. That is very complicated thing. Just for as of now, you just know advance tax is a tax you have advancely paid to the government because you know there at the end of the year there will be a tax. Okay. So this tax, the cash is already gone from your business. So how you can convert it in cash? Okay. So that's why it is also deducted. Now just put the value. Put the value in here. So current asset, we know what are the trade receivable. That is 50,000 plus cash and cash equivalent is more liquid. It is form of liquid. These two minus inventories. What is the value of inventories? 50,000. Now 50,000 plus what are the advance tax you paid? We have to minus it, 4,000. Now 80,000 minus 50,000 plus 4,000 means 54,000. Now what will come? Let's come. Sorry, there is another asset is there. There is inventories, there is a trade receivable. Sorry, there is a trade receivable also. Inventories is the trade receivable, cash and cash equivalent, trade payables. Sorry, you have just to now total from total current asset you have to minus it. From total current asset you have to minus it. Now your total current asset is total current asset. Now current asset is, you just take everything. That is inventory, that is trade receivable, that is advance tax, that is cash and cash equivalent. All are current assets. So you have to take all the things. That's come 1 lakh rupees, 1,34,000. Then from this amount, this current asset, you just deduct inventories and advance tax. That is not actually quick asset. So that's actually come 80,000. Now this is the quick asset we have got. Now current liabilities. We also need one thing, that is current liabilities. In ratio, you always need the two things. One is numerator, one is denominator. Okay. Now we have got the numerator. Now what is the denominator? Is current liabilities. What is the value of current liabilities? Now there is a trade payables and bank overdraft is there. That is trade payables plus bank overdraft. These two are current liabilities given by the example, and that is the value of trade payable is 1 lakh plus 4,000, so 1 lakh 4,000. Now you just put the value in here. You just put the value in here. Quick asset we have got, that is 80,000, and current liabilities also got by us, that is 1 lakh 4,000, and what is the value we got? That is 0.77 is to 1. 0.77 is to 1. Okay. Now that's actually said that if for your current liabilities, for 1 rupees current liability, there is only quick asset is 0.77 paisa. Okay. In case of liquid quick ratio or liquid ratio, you just 1:1 will be the ideal or most favorable ratio for you, because 1 rupee of current liabilities, you should have 1 rupee of current asset. Okay. So if this is a 2:1, means there is a 2 rupees current asset for 1 rupees liability. If you think this quick ratio is very good, it is not, because your most of the short term investment is the resources you are used is not properly used by you, because so much 2:1 for rupees 2 for 1 rupees of current liability do not need. Okay, so you can analyze that way. In this case the thing is not good actually, because this is less than 1, 0.77, so there is not also 1 for 1 rupees of liability, there is not 1 rupee of quick asset is there in your organization. So it is not, we can say the organization is very favorable position, it is not going well actually. So for today that's all. This is the end of the class. Hope you are well and safe, and thank you for watching.